Hi again everyone, this is part 2 of our two-part series. In part 1 we used CodeIQ to complete the bookkeeping for a Xero client with over 1200 transactions, 10 invoices all extracted using OCR, posted to Xero, everything matched, categorized, proper VAT treatment, everything with a contact in under 4 minutes. So in part 2 we're going to use LedgerIQ, which is also included in your subscription with the IQ suite along with CodeIQ, to analyze what we've just posted. Here's LedgerIQ. We're just going to click this button here because we've used Xero, but if you use Sage or QuickBooks, you can click these buttons and it will connect to whichever Xero account you're currently connected to on the IQ suite, pull the general ledger and create the financial analysis that we're going to view now. So we click this button and we're greeted with the overview dashboard, which gives you a brief overview of what's going on with the general ledger, including your expenses and revenues. Now, LedgerIQ has 40 plus financial analysis modules, many of which you're already familiar with, but some, as we go down this list here, are significantly more complex than anything you'd find on your software. And we're able to actually extract CFO grade analysis from this. But today we're going to put ourselves in the shoes of a business owner. A lot of this might be gobbledygook to them. I'm just going to quickly talk through some of the modules that you'll see, like the break-even and CVP and expense structure. You can see that here. You can set your budgets. Let's say, just for the sake of brevity, we're going to set our budgets to 95% of the actuals and confirm, and you can compare what your actuals are like with your budgets there. It goes quite in depth. Every single submodule has several views. And there are 40 plus modules here. So today we're going to use Rick to analyze this for us. So let's go back to the overview dashboard. Here's Rick. You speak to Rick in natural English language and Rick responds to you like a CFO. So again, we're putting ourselves in the positions of a business owner who's just completed the bookkeeping using CodeIQ and they want to find out a little bit about their business. So let's role play. Let's say, my father left me this business. I'm not sure what I have here. Can you break this down for me and tell me, do I have a gem or a problem? Let's see what happens. What Rick's about to do is he's going to take what I've just said to him and he's going to give me a tour through some of the modules. He's going to simulate events. He's going to use the front end sliders. He's going to basically answer my question using as much information as he can as possible. So let's go for it. You see he's thinking there. Okay, so let's expand this. Starts off, I'm so sorry for your loss. Taking over a family business is a significant responsibility. I'm not going to have the time to read this through to you as it's doing the tour, but you can see he just went to the profit and loss. Now he's gone to liquidity command center. And he's saying our liquidity position looks quite solid with our current ratio of 1.45. Now we're on to financial health scoring. In excellent financial health, that's good. Altman Z-score of 8.42 firmly places us in the safe zone. And then he gives a final breakdown. Okay, so let's outline this. Our Piotrowski F-score of 7 out of 9 confirms that our core operations are of high quality. So he picks that up on the financial health scoring module there. Okay, optimize, let's see. Recommendations. Address the leverage concentration, so our debt to assets ratio of 92.2% is high. That creates unnecessary structural risk. While our business is profitable, a large portion of our cash flow is currently being consumed by overhead rather than building equity. So the action, we need to look at the debt and leverage module to identify any debt which can be refinanced or paid down aggressively using our current cash positive operations. Recommendation 2, optimize the advertising drain. So our advertising spend of that amount is our single largest operating expense. So you can see it goes quite in depth here. We are in a strong position, but the business is currently healthy on debt and heavy on acquisition spend. So by tightening these two levers, you can significantly accelerate your equity growth. Okay, let's continue. Let's say I'm curious about being able to fund a loan. So I want to take a 30k loan, but can the business afford this? And if so, under what terms? Okay, so we're going to the capital structure intelligence module. And you can see it's just simulated a scenario in the leverage simulator there. Now it's went straight to credit risk and lending analysis, but what it does is it breaks down every single step its findings. So let's see. Okay, so it's broke that down, and now we're on cash flow analysis module as well. So like I said, it's quick, but it does break it down at every step. So it analysed our capacity for the 30k obligation. So our debt to equity ratio is 0.89 and our interest coverage ratio is exceptionally strong. So this indicates we've got significant breathing room, but it's never that simple. So it modelled a 30k increase in our debt, and even with this added burden, it's found that our interest coverage remains robust because our operating profit of 82,000 is very healthy relative to our current interest expenses. Then it went to look at our specific loan capacity in DSCR, analyze the impact of a 30k loan, says that we're healthy in that scenario. Adding 30k in debt would slightly exceed our current asset-based capacity limit. Whilst our cash flow easily supports the service of this new debt, you should be mindful that it would push your debt to assets ratio higher than the current 44.57%. Then it went to cash flow statement. Regarding your loan repayment capacity, you have generated sufficient cash to cover near-term obligations, but given the volatility in your core business account and the high dividend outflow, it is critical to ensure that any proposed monthly loan repayments are comfortably covered by our recurring operating cash flow. And then it gives a proper breakdown at the end there with the recommended loan terms. Aim for a 36-month loan term. Repayment structure, ensure you negotiate interest-only options for the first 3 months if you anticipate seasonal lulls, given our cash flow volatility. Covenant protection, ensure any agreement allows for a minimum current ratio of 1.5. And then tax provision, do not use the loan proceeds to cover your £26,817.36 tax liability, that's our corporation tax liability. Keep your financing for growth/operations only to avoid a debt to pay tax cycle. Cool. And then it gives us actionable next steps as well. So you speak to Rick like a human being, it responds like a CFO. Let's ask a couple more questions whilst we've got the video flowing. How long can I survive without revenue? On everyone's minds really today. So it wants to calculate our cash runway. So it's went back to the liquidity command center. We've got a solid cash position. Goes to expense structure analysis to analyze our expenses. To determine our burn rate, it runs a simulation and analyze the expense structure. So our average monthly fixed burn rate is £12,757.89. And then it synthesizes this into a cash runway calculation based on our current cash reserves and monthly burn. And you can see there, that's what that looks like. So let's see, key takeaways. Liquidity buffer, operational efficiency concern, and working capital. And it gives us recommendations. That is awesome. And it's exactly what business owners like to see. So that's your little tour of LedgerIQ. I tried to keep this as quickly as possible, but it's obvious that this goes in quite heavily in depth and takes quite a while to figure out. So for the purposes of a very quick demo, I think I'll call it a day there. Thanks for watching my two-part series. Part 2 is on my timeline or on YouTube, so you should be able to catch that there. Thank you very much, and goodbye.